Morning and welcome to our SURF webinar. We are certainly very excited to be with you and share this part of the morning with you. On the panel with me today, I've got Marius Kuyler from our investment team, and I also have on the panel with me Leanne van Wyk, Director of ICTS. And so, of course, respectively, Marius and Leanne will be taking us through this morning's topics. Just a few house rules before we start. All of your questions can be entered into our chat box. Both Marius and Leanne will take a few questions online, of course, during the course of the webinar. And then whatever we cannot address during this time frame, we will actually be responding to them via email. So without further ado, I'm not going to take too much time. I'll kick over to Marius, who will start off for us.
Awesome. Thank you very much, Imtiaz. And to our esteemed viewers, hello and welcome. So the problem statement for today, and I'm reading from the brief that you all received on the webinar invite, is as follows. Current rules allow retirement funds, retirement annuities, and preservation funds to allocate up to 45% of their portfolio offshore. But this potential is often underexploited by cautious investors and asset managers, a notable oversight considering South Africa's narrowing investment landscape and volatile economic and political scene. That there is the problem statement for today. Now, the solution to that problem statement is Sygnia's new offshore optimized strategies for retirement savings. The ultimate benefit then of the solution to the problem statement is ultimately the ability to consult on and invest in a range of funds that are expertly positioned to maximize growth over the long term. Ladies and gentlemen, you're with me, Marius Kuyler, for an in-depth exploration of the Sygnia, Signature, and Skelton Pro Fund ranges. Now, since in-depth is what it says on the tin, I will try to stay true to that, and therefore I want to just introduce some borders around the discussion to just delineate the scope a little bit. We are, for the context of today, already in the world of umbrella funds. We very likely, the fact that we chose careers in umbrella funds in the EB space very likely means that we agree that this way of saving for retirement is the way of the future. So this won't be a discussion of why umbrella funds are cool. This will also not be a discussion of economics and markets. For those, Sygnia has the ECOS webinars that our investment head does. We also have signals that's available in terms of the more detailed macro strategy overviews of how we think the global opportunities and risks present themselves. This is also not an introduction to the entire Sygnia philosophy. Rather, the intended audience is professionals like yourselves, passionate about matching employee benefit needs of organizations with investment solutions available to them in the South African investment landscape. So there will be a bit of a primer on where the pro range fits into the existing products and the existing philosophies, but a level of familiarity with the existing landscape in terms of economics and products that currently exist is assumed. So a word, before we ultimately begin, a word on SURF webinars as a forum. This is the first SURF webinar we've done in a while. I think the best outcome that we can have for these is for it to be a forum where we give feedback and engage as much as possible. I think for today's purposes, if you find yourself going to more and more meetings where South Africa and overweighting South Africa and investments domestically and Reg 28 and so forth are controversial topics, then I think this webinar will make you very happy. And please, if that's the case, engage with us. Treat the ask, the question facility on Zoom, treat it as a comment section. Tell us if you like it. Similarly, if you came here for something else, also let us know that. So please treat that question section as a comment section, and let's hear from you and make these as useful as possible for ourselves over if we make them a tradition. So up next then, a short primer on philosophy so that we can just understand where these pro funds fit in. So here at the very top, I have something that will probably be one of the first choices in terms of the overall investment strategy when we are solving the problem of employee benefits. So here we have the classic passive and active balanced philosophies. You all probably know very well that Skelton fits into the passive philosophy, Sygnia, the passive and active blend, and Synergy, the active balanced philosophy. And here, the thing to understand is that the pro ranges will form a complement to the existing passive Skelton range and the existing passive active Sygnia range. And I won't give too much detail here, but we all probably are very aware already that specialist just means using active basically where it works, and passive where it works to keep the costs low, but also the alpha high. And the balanced approach is then purely that synergy range. And in order to disambiguate a little bit, there is no pro on the synergy side. So in terms of the way I kind of contextualize this webinar at the very beginning is problem, solution, benefit. If we go back to that problem side of things, the question is, have you ever been in a meeting where SA is controversial? So you clearly find yourself surrounded by decision makers who believe that SA is not an ideal place to invest. Now, this is an argument we can spend a lot of time on. I specifically didn't want to make today's webinar arguments not to invest in SA. I believe in any given room, if the pro range is the right product for the investor, those arguments will make themselves. I can very briefly state some things. We can talk about relevance in terms of the SA market and how SA assets serve us in our portfolios. If you reason here from first principles, you can look at something like a global market portfolio, which reflects the total intertemporal demand and supply of capital in the world. This is why it is the market cap weighted global market portfolio. Now, of that global market portfolio, the JSE is around 1%, fairly recently, even less than 1% of the global market portfolio. So in terms of relevance, if you reason from first principles, let's say, for example, you land on Earth and you want to make a global portfolio, JSE is only 1% of that. In terms of concentration, there's so many statistics here, it can get very long, but some headline points is, for example, that in SA, only 10 shares make up about 70%, 68% or so of the JSE. It's amongst the most concentrated markets in the world. For context, the US, the same stat in the US, so the 10 biggest shares make up about 32% of the market. In Japan, the 10 biggest shares make up about 26% of the market. So the JSE is highly concentrated. JSE companies, listed companies, have halved in the last 30 years. The biggest companies are multinationals anyway. We did some research showing that about between 60 and 70% of revenue drivers on domestic indexes are offshore anyway. If you think that's a good thing, then Pro is very ideal as well. But in some other points, I read a report where trading for the third quarter of last year versus the year before on the JSE, so trading activity is down about 20%. You can also reason in terms of governance in South Africa, as I'm sure many of us experience in our client engagements. From a governance perspective, SA gross loan debt to GDP is at its highest since 1947. We sit with tremendous debt servicing costs, a budget deficit that doesn't give us any comfort. Education, the most expensive item on our budget, and so forth and so forth. We don't see supply side discussions in the way that SA is governed. But as I've said, these points are going to make themselves in the meeting. So this is not a webinar to argue against investing in SA, but if you sit in a room and you find for yourself that there's genuine appetite here for a product that invests with a global investment bias, that's where Pro fits in. So this is how it will look, and this is where Pro is the existing range of funds that Pro is added to. I'm sure everyone on the call is very familiar with the Sygnia range, the Skelton range, the Synergy range. So the Sygnia is that specialist multi-management range. Skelton is passive, keep it low cost, keep it passive. And Synergy is then the balanced multi-management solution. Signature will get a complement called Signature Pro, and I'll deal with a bit of detail on that later. And Skelton will also get a complement channel next to it that also has a Skelton Pro 70, Skelton Pro 60, Skelton Pro 50, and 40. So these two Pro ranges are complements to the existing Signature and Skelton ranges, and they are available as member choice. So in a more structured framework, if we consider this from a perspective of modern portfolio theory, and we think back to Harry Markowitz from 1952 and his efficient frontier research that he did in the framework of modern portfolio theory, this is where the lineup of offerings in the Sygnia basket fits in. So Pro Skelton and Pro Signature, again, I emphasize, are channels that fit right next to the existing Skelton and Signature ranges. There is a bit of nuance, and I'll get to how they have fixed asset allocation that maximizes offshore a bit later, but this is how it looks like if you consider it in the context of an efficient frontier. Very high risk funds will then have Signature 70 as you're used to, but complemented now with Signature 70 Pro. Skelton 70 also as you're used to, but complemented now with an offshore solution, Skelton 70 Pro. Another small thing I think that might stand out for those of you who are very, very familiar with the range is on the very left, very bottom, we have the Skelton Absolute Fund, which just fills that gap that we've seen there is a bit of demand for between the very low risk funds and pure almost no risk or money market funds. Skelton Absolute fits in there. Let me know if there's appetite. We can cover that in a future webinar. But this is very much where the offering fits in terms of your trade-off between performance and risk. So the problem being done then, let's talk a bit about the solution, and this is where the Sygnia product positioning fits in. So here I'd like to contrast firstly Signature, the existing Signature and Signature Pro, and then on the next slide we have Skelton and Skelton Pro that we're going to contrast. The important thing, so Signature is first up. The important thing with Signature and Signature Pro is that both are still specialist multi-manager funds. I think there's a tremendous amount of sense in this. These funds basically take 20 years or more of research to see where active had a chance of working, where passive had a chance of working, and uses a specialist multi-manager solution, uses active where it makes sense, and uses passive where passive makes sense in order to keep costs low, but still generate that alpha. So both Signature and Signature Pro are specialist multi-management solutions. The big difference is in the way they allocate their assets. So the existing Signature range has an active asset allocation methodology, and you can see it falls in ranges. We can use Signature 70 as an example. Its limits, or its constraints rather, on global is 30 to 45% for the high risk 70 fund. In equity and property, it has a band between 65 and 75% of its allocation. In the Signature Pro world, it has a fixed asset allocation, and that's the key difference here. And if we understand that sort of at this point of the presentation, a lot of things later are going to make very easy sense. So fixed asset allocation that sets out to maximize offshore with higher equity, or it has an equity and property allocation that's on the higher side of the band for the existing Signature range. And here I think the particularly interesting thing is that you still get higher exposure to offshore assets even as you de-risk. And that's where a bit of nuance comes in here. What I see quite often is people de-risking up to retirement age, and immediately when they annuitize, their choices of investments after retirement they re-risk after retirement. This is not universal, it depends on the advice given and so forth, but there is a case to be made that as you de-risk, exposure to the growth drivers are still possibly a very good idea. What I will also point out just before I go on to Skelton is that the fixed asset allocation product range, which is the Sygnia Signature Pro range, is our best investment view for long-term savings. Then in terms of Skelton, very much the the same data going on, except in this case, both Skelton and Skelton Pro are passive solutions. So this is for the type of client who feels that passive is the right thing. Keep it low cost, keep it passive, and give me market exposure at a low fee. So both of these are passive. They also contrast in terms of the active asset allocation versus fixed asset allocation, the same as in the Signature case. So here also Skelton breaks down in ranges. With, for example, Skelton 70, its global allocation will be constrained to 30 to 45%. In equity and property, it will be constrained to 65 to 75%. Similarly, with Skelton Pro, the mandate is to maximize global exposure. You will keep that global exposure as you de-risk, and your equity and property will sit at the higher end of the risk bands of the existing Skelton range. Those are the nuances. Those are the important things to know. I'll just point out that this is also on the passive side. Skelton Pro is also the best investment view for long-term savings. It's just a passive variant of that. So it really depends on philosophy-wise, whether somebody wants active or a specialist multi-manager or pure passive. And I can't, when I look specifically at the de-risking element and staying exposed as you de-risk to the growth drivers in the global economy, I sort of can't help but think that this is one of those magic moments in time. The benefit of working for Sygnia is you get to observe these magic moments sometimes. I was on a fairly great opportunity for me. I had the chance to represent this team on TV sometime in January or February. The task was to talk about, the question set was all about the Skelton range turning 10. Admittedly, this was on the unit trust side. But I remember thinking, seeing the Skelton balanced range in the unit trust world, 11th out of 78 over 10 years, lowest fees in the land. I remember thinking how far ahead of the curve you must have been to know that this is the way forward and this is where the industry will go 10 years ago already. So sometimes I really look at those above me in awe. I have sort of a front row seat to all this magic happening. The most recent moment of magic you'll also probably all remember is the FANG fund and the FANG strategy that made a lot of people very happy. And as an observer, I can't help but think that this idea to keep exposure as you de-risk to global, and ultimately the way these pro funds wrap together, I can't help but believe that this is one of those magic moments where 5 years from now we're going to look back and say Sygnia knew the way forward. But anyway, let's drill down into some detail. And here I've also got it's quite a bit of detail, I admit, but I've also got Signature Pro, immediately after that Skelton Pro, and this is the drill down into the allocations of the portfolio. So what we're looking at, for context, once again, first is per asset class. We start with SA equity, SA property, SA bonds, and so forth. And for each asset class, we have the various building blocks or funds inside them, and then the weight that Signature 70 Pro, Signature 60 Pro, Signature 50 Pro, and 40 Pro will have in that fund. Now, when you look at this for long enough, it starts to make a bit of sense. Unfortunately, for all of our attendees, I have been looking at this for long enough. Some things stand out. The first thing I think that's important to mention, to get behind what the strategy really does, is to look at global equity. And the key thing to show here is that between Signature and Skelton, the global exposure is, as near as makes no difference, the same. That's the first thing. Then another very important element is that as you de-risk, so as you go from 70 to 60 to 50 to 40, your global equity or global exposure still remains the same. I think this is the very innovative point to raise. So global equity, global property, global cash, you can almost wrap the entire global section of this slide up and say, okay, that's the same between these two, and it pretty much stays very much the same as you de-risk. Then the contrast is just between Signature and Skelton. I trust this is a contrast you've heard quite often, but I also think it makes a tremendous amount of sense if you look at domestic assets. So as a primer, again, I motivate everybody on the call to have a look at the SPIVA scorecards, the SPIVA. You can Google them. They come up immediately. It's research by S&P Global that looked at over 20 years worth of returns, active returns and passive returns the world over many jurisdictions and over many time frames. And they show you basically historically how would you have performed if you chose to invest actively or passively in which countries. Now, there might be a bit of theory underlying that data. The short of the long is in highly efficient markets. We can use the US as an example. The active philosophy really makes very little sense. If you look at maybe you can have a look at the SPIVA scorecards, but maybe if you look at 10 years for active versus passive in the US, I think active has about a 8% or 10% chance of outperforming its passive benchmark. Highly efficient market, this is probably speculatively because they have many buyers and sellers, many assets being bought and sold, and high informational symmetry and high speed information, and therefore the active manager's staple information can't be exploited for alpha. However, in less efficient markets, we can here use South Africa an example, with fewer assets being bought and sold, fewer buyers and sellers, less capital in general, and more informational asymmetry. This is the speculative theory of why the SPIVA scorecards look the way they do. But the point is that the data shows in SA, I believe over a 5-year time frame, you still have a 50-50 chance between active and passive in South Africa. And that informs, to an extent, the decision-making around where active has a chance of working, where passive has a chance of working. And that's a big reason why globally we keep things passive. It brings the cost of the portfolio very much down very much. And then we choose to use the specialist managers in the multi-management component, which is the domestic component, where active managers actually stand a chance. For that, we have our manager research function headed up by Pumlile Smith, and there we do the work of choosing the managers that form the specialists in the signature portfolio. And then Skelton is the pure passive solution. Here, I think I'd also just point out that the global side of Skelton Pro stays the same as Signature Pro. It also uses the themes in a passive landscape where passive works and markets are very efficient. You can still use thematics to generate alpha at a low cost. So that's a very nice thing in your global allocation. But then domestically, things in the Skelton Pro range are also kept passive and kept low cost. So, for example, in SA equity, you're a pure passive SA equity investor. You invest in the capped Swix tracker portfolio in Skelton Pro. In Signature Pro, similar to Signature, the existing Signature, in SA equity, you'll invest half passively and half will be, in SA equity, for example, will be split between the specialist active managers. If you have those couple of ideas down, then you very much get the methodology behind Pro. Then we can go on to, if you remember how I contextualized the webinar, we started with a problem. I've introduced the solution to you, and now your question will be, what's the benefit? So in terms of benefit, we can talk about risk, we can talk about returns, and that's what we'll do now. Now, as an investment consultant, I'm often asked to look at tables like this and spot, is it good, is it bad, what's going on here? For that, of course, the first approach could be something like a performance versus benchmark way of looking at it, or perspective. And here it's a very encouraging story. So first of all, on the very short term, take this with a pinch of salt, but in a monthly return, typically you would want more months than not for a high risk portfolio to capture more of the upside in markets than a low risk portfolio does. Similarly, in down markets of the very short term, we keep monitoring over a monthly horizon and so forth. Are the standard deviations okay? And if the market goes down, do the products function according to design? So therefore, does a high risk fund capture more of a down market than a low risk fund? We want to see the stability in the low risk funds. We want to see the growth in the high risk funds. And this is where the equity or risk asset allocation forms sort of a whip. So it kind of helps, if you think of it in terms of an efficient frontier, it kind of helps to introduce that growth over the long term with the stable assets, of course, then forming the safer side, less risky side of the portfolio. So the very short-term things seem to be going very much according to design, which is very encouraging. And then I take a portfolio manager perspective on this. And here it's all performance versus benchmark. And Not to drill down into every number on the slide, these will be available after, so we can all peruse them as much as we want. But we can use, for example, the longer term for high equity, high risk fund as an indicator of whether we're happy with performance versus benchmark. And if you look at Sygnia 70 Pro, it's the first line, and the long term, we can look at 5 years. Very, very encouraging sign there. So we see that versus the benchmark, the strategic benchmark, which is very fair. It's not a CPI plus X or Y benchmark. It's a fairly set market benchmark. Sygnia 70 Pro did 12.1 over 5 years, or would have done 12.1 over 5 years, and the benchmark did 9.6. Similarly, that 3-year number is going to be 2.3% ahead of the benchmark over 3 years. But then I take a more important perspective, and I'm sure I'll resonate with our viewers on this perspective, and that's the member perspective. And that is to we can look at the same fund, Sygnia 70 Pro, prefer a long-term look, and we can look at CPI. That's ultimately, in terms of our members retire and the quality of their lives, determined to an extent by their retirement savings. That's the important question, versus CPI. Did you add purchasing power to the portfolio or not? And it's an extremely encouraging picture in terms of CPI. So if we take that member perspective, we look at 5 years and we look at a Sygnia 70 Pro, over a 5-year horizon, you would have outperformed CPI by 7%. And very, very, very few funds, as I'm sure you're all aware, are able to achieve that kind of growth in the current environment. Similarly, we can look at 3 years. So the CPI plus number there would be that 11 minus 6.1 means a 4.9%. So CPI plus 4.9% over 3 years. And I'm sure all of you are very familiar how tumultuous these last 3 years have been in markets. Very few funds are able to achieve that CPI plus 5 or 4.9 in this case over that 3-year horizon. So extremely happy in terms of how these funds perform versus strategic benchmarks from a portfolio manager perspective, but also very happy with how they perform in terms of ultimately the goal, which is member retirement outcomes, member quality of life after retirement. CPI plus 7 over a 5-year horizon is something to be very, very happy with. Now, if we consider how that accumulates over time, this could possibly be an even more important way to look at it. And this, I always say, remember, so I'll give just 10 seconds of context. I started working for Sygnia. It was about 4 years ago. I started in multi-asset trading on our trading desk. Then I moved through to the investment team, and then through to the investment consulting side. And what I saw in the investment team is a perpetual battle for basis points on the portfolios. The way Anton Swanepoel, Wessel, Brandt, Stephen and Pericles, etc., run these portfolios, they are obsessive about running them as efficiently as humanly possible. And sitting on the other side of that equation now, seeing cumulative growth over time, it puts the whole story together, because that battle for basis points actually accumulates into a tremendous retirement outcome difference over time. So this is 100 Rand invested 10 years ago, or in June 2013, as the slide shows, and how that would have grown in the pro funds, in the regular Synergy, Sygnia, and Skelton funds, and then versus all the peers, versus the median and all the peers on the bottom of your screen. The perspective here is very much, I heard this analogy the other day. I hope, seeing as I am speaking to professionals, it's not condescending, but I thought it was very interesting to look at it that way. So the cumulative return slide is like looking at a marathon. Everybody started at the same point, at the same amount of time ago, with 100 Rand invested. You ask here, who ran the marathon the best or the fastest over the entire scope of the marathon? And 100 Rand invested into Sygnia 70 Pro at the beginning of this horizon would have grown to 324 Rand. The global large manager number is missing there, but it might be better because it will be considerably lower. Similarly, Skelton 70 Pro, 100 Rand would have grown to 313 Rand. So I find this tremendously encouraging. If we remember our fiduciary duty at the end of the day and who we're here for at the end of the day, which is members, this is a very, very encouraging picture. And then to surveys, for illustrative purposes, I wanted to show you an investment strategy comes up out of theory, it comes up out of reasoning, out of whatever the investment process of the relevant asset manager is. But then we expose it to back tests to see how would this strategy have behaved in history. And here I bring the same marathon analogy in again. When you look at surveys, and this is the cool part of the analogy, is when you look at surveys, you're actually effectively standing at the end of a marathon, the as at reporting date, and you're asking which runner ran the last 1 kilometer the fastest, and which runner ran the last 3 kilometers the fastest, which one ran the last 5 kilometers the fastest, and you rank them according to how fast they ran the last couple of kilometers. And I think that's a very interesting perspective on surveys, to understand that contrast between cumulative growth and then looking at a reporting date in time and looking back at the performance over various timeframes. But nonetheless, this is how it would look like. And once again, ladies and gentlemen, it's an extremely encouraging picture. As I've said, we have to expose any strategy to back tests and to see the growth is absolutely incredible. So I don't think anybody would be remotely unhappy with what you see on your screen. Excellent numbers over 1 year. It looks completely different than peers because it is completely different than peers. And then I'll go through quite a couple of surveys here, but I think if I could just, the main point of this stage of the webinar is we spoke about the problem. We spoke about the solution. We drilled down into the portfolio to see what the solution does. Now, this is basically the benefit part of the webinar. So in terms of what the benefit ultimately is of investing in something like Pro, it is Pro performance, yes. It is investing in a methodology that will expose you to the growth assets in the world in your growth period, and even as you de-risk, you will keep exposure to more growth assets, and ultimately a global opportunity set is what you get. So in the context of some of the first things I've said, the relevance of the South African market in terms of size, in terms of concentration, and in terms of its effect and contribution to the world, if you build a global market portfolio and you go by market cap, which is a very reasonable assumption because of the supply and demand forces of capital over time, then the global market portfolio should be your benchmark. And you can see here the benefit ultimately of investing in Pro is you get access to this global opportunity set, not constrained so much by investing domestically. Ladies and gentlemen, I'm going through to more surveys. This is the medium equity multi-manager survey, and this is how Pro would have looked like on this survey. So we definitely see that the fund is behaving according to the way we would like it to. If we look at these surveys, the high equity survey, very much the same story, completely looks like a different strategy on the survey because it is. And it's definitely, again, the Pro performance comes through here. And remember, in the back of your mind, access to that global opportunity set. That's the core value offering of the Pro ranges. This, ladies and gentlemen, is my last slide before I go to some questions. I hope my question box is nice and filled up so far. But I think here the innovation is quite clear. And if I could put it very simply, if I look at this almost independently, Sygnia has found a way to generate tremendously improved return at very similar levels of risk by capitalizing on this global opportunity set, by creating the Pro funds for investment. And you can see the y-axis is not standardized. It starts at 7.5%, not at 0. So you can see all the peers are lumped together here on the bottom right side of your screen. The bottom side, remember the y-axis is your return, the x-axis is your risk, so your standard deviation of your fund. And you can see if you're positioned on the very bottom right side, you're exposing the fund to a lot of risk, but not generating return. If you're positioned on the left bottom, you protect from risk, but you also protect from return. The ideal place to be on the efficient frontier, is sort of the left top side, would be the ultimate thing. And here we can see some things. We can see the higher equity allocations introducing that whip that I spoke about earlier. I thought of the perfect analogy beforehand. I couldn't find it, but it's more like a whip than a flagpole, for example. So equities very much go up and down. So you can't expect your equity allocation in your portfolio to be a flagpole that keeps the higher risk portfolio higher perpetually. No, rather it's rather a whip. So it introduces risk into the portfolio. You typically expect the higher equity allocations, higher exposure to risk assets to introduce that risk into the portfolio. And ultimately, hopefully that risk carries over into superior returns over the long term. But this is a very beautiful picture. I will leave things here, and I will open the floor now to any questions. Let me just stop sharing first. Okay, to my co-presenters, it seems we're still quiet on the question front. So, Leanne, I guess it's your time to shine.
Thank you so much. I really appreciate that, Marius, and I will try my best to shine. And thank you to you as well, ICTS.
Yeah, thank you, Dan. So yeah, thank you, Marius, for that fantastic presentation. I think to the viewers, you'll realize from what we've just presented, you know, it's still sticking true to our core, and that's to provide dignified outcomes for our members. So we'll kick over now to Leanne. That's got, of course, a critical update on the two-pot system. I'm sure everybody is burning to also understand what that's about. So Marius will be exiting the call now just to, of course, go to some prior commitments. Thank you again, Marius. Keep well. Over to you, Leanne.
Thanks, everyone. Have a great day.
Thanks very much. I always love listening to investment consultants because the language they use is sometimes almost poetic, you know, talking about whips and flagpoles and running races, etc. So I hope you enjoyed it too. Okay, so thank you so much for having me today, and it's good to spend time with you again. So what I'm going to do today for the first sort of 45 minutes or so is I'm going to just do an overview of two-pot. And why we decided to do this is because there have been so many changes along the way in relation to the legislation and how it's understood, etc., that, you know, people have attended bits and pieces, you get updates as it goes, but really this is a consolidated view of what two-pot is now. So the idea is to just present two-pot to you in a put together way. So if I could just ask you and encourage you to please add your questions in the Q&A, because as I said, I'm going to chat to you for 45 minutes, but after that structured session, I'd really like to get to an unstructured, more chaotic session where we deal with questions and answers. And I'm going to try and answer your two-part questions there. So please feel free to add to the Q&A. Okay, so if we look at the two-pot system now, it's been a long road, hasn't it? If you guys have been following it like I have, it's been up and down and backwards and forwards as well. So we know now that the effective date for the two-pot system is 1 September 2024. I am always asked the question, Leanne, you know, is this gonna go ahead on the 1st of September? And my answer to that is the moment is yes, it is. You know, there's always a chance that, you know, whoever comes into Parliament after elections would look at changing or overturning the legislation, but I don't see that applying to this. You know, this is not something that needs a lot of money from government, for example, to implement. In fact, government is making money out of this. Yeah, I think it is going ahead. I'll tell you where the legislation is in a minute. So if we look at the legislation, and I've divided it sort of into the tax legislation, the Pension Funds Act legislation. So the Revenue Laws Amendment Bill, if you look at that little, those orange shapes there, that is with the president for signature. So it's actually very far along, and we are likely to see that before elections actually enacted. Then, in addition to that, on the right-hand side there, we've got the Pension Funds Amendment Act. Now, this is the piece of legislation that makes the changes to the Pension Funds Act that we need to implement two-pot, and it also makes changes for 3 public sector funds, for example, the GPF, to their own legislation for two-pot. Now, that is with the NCOP. I know it was referred back to the National Assembly because there were a couple of changes, but we expect this to be approved today, possibly. And then it will go to the president for signature as well. So we are fairly sure that this legislation will also be enacted before elections. Then we have a piece of legislation called the Revenue Laws Amendment Bill 2024. Now, this is a bit of a curveball because this Revenue Laws Amendment Bill 2024, or RLAB 2024, as I'm going to call it today, actually makes changes to that other Revenue Laws Amendment Bill that has not yet been enacted. Okay, and that is causing a little bit of chaos in that, for example, we've got rules to submit, we've got communication to do, we've got systems to change, etc. And that Revenue Laws Amendment Bill is not just technical changes to the Income Tax Act. There's some quite fundamental two-part changes there as well. And I am going to talk to you a little bit about those today, or some of them today. Okay, so that's where the legislation is now. If you've got more questions on that, please feel free to add it to the Q&A. So if we go back to the beginning and we say, what is the whole point of the two-part system? Why are we doing this? Okay, and what are the objectives? We've got these 2 conflicting objectives. The one is obviously keep more money in the fund until retirement. And that's the whole point of the retirement pot. The other objective is to allow a bit of cash to leave retirement funds while members are still in employment, so that they don't, leave employment to gain access to benefits. So they are conflicting objectives, but you've seen how two-pot has put these together. But what I have seen is that much more is known by our members, as an example, about the access to cash bit than the other bits. The preservation, but there is a bit that's going to be stuck in the fund until retirement. And what I've found is that when I've spoken to members themselves, they're very focused on, number one, the access to cash and what that'll cost them and tax, etc., etc. But we aren't always giving them the good news about the fact that they're actually going to reach retirement in a better place. And I think it's important to communicate that to members. So who does the legislation apply to? Pension and provident funds, both DB and DC, retirement annuity funds, for sure, preservation funds, pension and provident, and public sector funds. Okay, the bigger question, I think, at the moment is who does it not apply to? Okay, and these exemptions are a little bit confusing at the moment. So we know that that special category of over 55s, who I'm going to talk about in a minute, we know that they are exempted. They are defaulted out of two-pot, and I'm going to talk about them in a minute. Beneficiary funds out. Unclaimed benefit funds are out, but I think that this will be extended not just to unclaimed benefit funds, but to unclaimed benefit members in any fund. Okay, so that to me is the more sensible interpretation. Then pensioners exempted. The last 2 are not in the Revenue Laws Amendment Bill. But of course, if we can get these 2 types of funds exempted, I think that would be a sensible thing to do. But from what I can see so far, it looks like the FSCA and Treasury are on the same page about two-pot not applying to dormant and closing funds. So I hope at some stage they're actually right then into the legislation. But on liquidating funds, so this is where your liquidator has actually been appointed. So that's your point of liquidation. So on liquidating funds, I think that they won't be exempted. Okay. And I think that this is something that the FSCA is currently thinking about and discussing with industry bodies, etc., etc. But my feeling is that they won't be exempted. All right, and that is a pity because, you know, there is limited application for the two-part system. If I sip water, I'm not being rude, I'm just preserving my voice. Okay, so that's what we've got on exemptions so far, and there's still some discussion going on in relation to those last two categories. So let's start right at the beginning, bring everyone along. And as I said, this is what it is at the moment. So I'm going to look at what are the pots, how do the pots fill up, how do the pots pay out, so benefits, what pays out on retirement, withdrawals, savings withdrawal benefits, death benefits, etc. Then we're going to look at that very special category of older members, our over 55s. So we're starting with this very blank page, right? And we know that 1 September 2024 is when two-pot will become effective. As at that date, what will happen is that we will get 3 pots. Okay, so we'll get a vested pot. Now, the vested pot is very simple. It's everything that you saved in the fund on the 31st of August 2024, and then you get fund return added into that. And you get 2 other pots, your savings pot and your retirement pot. Okay, we all know this. Then we get seeding. So seeding is 10% of what you've got in your vested pot on the 31st of August, capped at 30,000. So whatever you saved up before the legislation comes in, you get 10% of that capped at 30,000, which is your starting balance in your savings pot. Okay, so just so that you know where that amount comes from in the vested pot. So your vested pot, I think of it as a pot with like layers in it. Your vested pot will have 2 layers in it when the legislation comes in. And these are layers from an annuitization point of view. So for our members of Provident Funds under 55 on 1 March 2021, right, that's the watershed date for age. For those members, they are going to have a vested portion from an annuitization point of view and a non-vested portion sitting in their vested pot. Okay, and your seeding will be taken proportionately from those 2 layers. Okay. So that is for your younger members. For your older members, your over 55s, everything they've got in that vested pot is vested anyway, so it doesn't make a difference. You got questions on this again, please put it in the Q&A, guys, and I'm very happy to repeat it or to clarify anything. So let's just do a couple of examples, and these examples I'm finding are quite useful for members. So if we look at seeding, Helen, you've got your hand up?
Sorry, that was a mistake.
Okay, no worries. So if we look at the examples for seeding, let's just have a look at one. So if we take the 31st of August, which is the day before two-pot comes in, and Jane, a member in our fund, has got 100,000 Rand in the fund. Okay, so 10% of that is 10,000 Rand. That means she gets 10,000 Rand transferred to her savings pot as a starting balance on the 1st. Example 2, Sipho has got 400,000 in the fund on the day before. 10% of that is 40,000, but the 10% is capped at 30,000. So Sipho will get 30,000 in a savings pot in the fund on 1 September. Okay, so that is how the seeding works, and that is how we start with an amount in our savings pot. And then our savings pots and our retirement pots build up from the 1st of September. Okay, I nearly said the 1st of March. From the 1st of September 2024, they build up every month. So for our ordinary members, I'll talk about older members later, but for our ordinary members, no, they will never have more contributions to their vested pot. Their contributions will all, after 1 September, go to the savings pot and the retirement pot. And you will see here, I say total net contributions from 1 September. What I mean by that is all contributions, including, for example, additional voluntary contributions, less expenses, like, for example, fees or insurance premiums, etc. And then the split happens, okay, of contributions. And you get 1/3 into the savings pot and 2/3 into the retirement pot. And no, you can't change that. Okay, I'm often asked that question as well. Member can't change it, the fund can't change it. That is an automatic split. Okay, then in addition to that, those contributions that come into your pot, there's also fund return that gets allocated to your pots, and also this funny wording that says amounts credited. And what this simply means is if you have bits and pieces coming into the fund, or allocated within the fund. So say, for example, the fund allocates future surplus as an example. All the legislation does is it allows for that to come into the pots. It doesn't say how or in what proportion, but it allows it to come in. So that's what that amounts credited allows. And then, of course, at any time, the member can decide, right, I want to move money from my vested pot or my savings pot into my retirement pot, and they can do that. All right, then what can members take out of their savings pot? So this is the bit that they often are concentrated on. So from the 1st of September, a member can take what is called a savings withdrawal benefit. So this is that new compulsory statutory benefit that we have to work into our rules, which basically allows members to take money out of their savings pot while they are still employed, right? That is the savings withdrawal benefit. They don't have to have a reason for it. So they don't have to say, I'm in financial distress or whatever the case may be. They don't need a reason. They don't have to leave employment or the fund. And they don't have to take it. And we like to point this out to members to say, you don't have to take it now. You don't take it now, it'll still be there next year. You don't have to take it all. You can take a portion, leave the rest. So there's at no stage do you have to take it, because if you don't do that now, you're going to lose it. Okay. So often that sort of calms members down, and then they say, okay, I don't need it now, I'll wait for it. And then, of course, there's no maximum amount that you can take as a savings withdrawal benefit. It just depends on whatever you have in your savings pot. But then there are some rules when you take money out of your savings pot. When I say rules, I mean, it's basically legislation. This is not us making up rules, this is law. So the first thing is that 2,000 Rand is the smallest amount you can take out of your savings pot. And that is calculated before you apply any tax to it. Okay, so it's 2,000 Rand is the smallest amount. You can take that out once every tax year, not 12 months, once every tax year. There is, at Sygnia, there is no fee for taking money out of that savings pot. At other administrators, they could be, but at Sygnia, the decision is that there's no fee for a member who takes money out of that savings pot. Okay, so your 2,000 Rand wouldn't be less fee apply for tax. It'll simply be your 2,000 Rand less whatever your tax is on that. It is taxed at the member's own marginal rates. Now, I've added in all the tax rates to the presentation so that if they are posted, if the presentation is posted, you can see them at the end, but I'm not going to go through them. But just to note that your savings withdrawal benefit is taxed at your own marginal rate. And then we have to protect deductions from members who are taking savings withdrawal benefits. So what I mean by that is if there's a divorce order, maintenance order, or one of those orders pending, misconduct at the employer, there's judgments or the employer's in courts, housing loans and guarantees, that sort of thing. So that's what I mean by deductions. We can't have a member taking money out of the fund through from their savings pot through a savings withdrawal benefit if we are not going to have enough money left to pay those sorts of deductions. Okay, so that means that in the Pension Funds Act, you will find a lot of changes to Section 37D, which protect those deductions from taking savings withdrawal benefits. Okay, and that means that when a member asks for a savings withdrawal benefit, we've got to ask them some of those questions. Okay, and that makes savings withdrawal benefits slightly less straightforward. Okay, members should be told that if you take money out of your savings pot, you are going to have less money when you retire. Okay. And also that you're going to have less cash to take out of the fund when you retire. So those are important messages and need to be part of the communication. But then, having talked about what comes out of your savings pot, let's not forget about the saving more for retirement objective. So that's the other objective of two pots. And here, I want you to remember that there's a part of the members' retirement savings that they can't touch. They cannot take it in cash until retirement. And that is the amount sitting in the retirement pot. And that amount will only ever be paid as an annuity to members. Members don't get this amount in cash when they leave employment. Okay, so that is a big change from pre-two-pot. It is always preserved until retirement. So let's have a look at the benefits that are paid out the fund. And let's start off with withdrawal benefits. Okay, so we've got our three pots. And we're going to look now at what comes out of these three pots when there's a withdrawal benefit. So the first thing that we know is that you can, if you are withdrawing, so you're leaving employment, you can take everything out of your vested pot in cash. So that's the first thing to know. Then the second thing to know is you can't take anything out of your retirement pot in cash. Right? That must either stay in the fund or be transferred off the fund to another fund. Okay. Your savings pot, you might get cash or you might not. Okay. And the rules around that are, remember the idea is that the savings pot only pays out once in a tax year. So you can take it out on termination of employment if you have not already taken a savings withdrawal benefit out of your savings pot in that tax year. Okay. The only exception to that rule that says no, you can't have two in a year is this. If your savings pot when you withdraw is very small, that is, it's less than 2,000 Rand, then you can take your savings pots on withdrawal, even if you've taken a withdrawal from your savings pot in that year. Okay, so a little bit complex, but we've put it all on the screen here, and you will see people starting to communicate this. So I think that this is something that definitely needs to be communicated to members. You know, we can't have members thinking that they can take everything out their fund on a withdrawal like they used to. Now, just on the taxation of this, your vested pot, when it pays out on withdrawals, tax in terms of your normal withdrawal lump sum tax tables. Your savings pot is taxed at your marginal rate. And your retirement pot, because it's not paying out any cash, your retirement pot is transferred tax-free or it stays on the fund. So three different bases of taxation. Okay. So it's important that members understand this. Just as a rule of thumb, generally speaking, your savings pot pays out and is taxed at marginal rates before you retire. Once you retire, you will see your savings pot, if it pays out, is then subject to normal taxation. And that means that you could get those tax-free amounts. Okay, so this is the withdrawal picture. Any questions, please add it to the Q&A. Okay, then how will pots pay out on retirement? So we know that on retirement, we're going to have part paid out as annuity and part paid out in cash. So how will that work? So we've got our same three pots on retirement. And our retirement pot, the savings pot, everything can be paid in cash out of our savings pot when we retire. If you decide you don't want it all in cash, then you have to annuitize it on retirement. Okay. your retirement pot, everything in the retirement pot is paid out as an annuity. People often make the mistake that, they say, oh, 1/3 is paid in cash and, the 2/3 has to be paid as an annuity. No, the full amount is paid from the retirement pot as an annuity. Your vested pot, remember I said to you, this is the one with layers. This is the one with the annuitization, vested and non-vested portion layers. Okay, so this is going to pay out part cash, part annuity, depending on those layers, which I'm going to come back to in a minute. De minimis amount still applies on retirement. There's just a slightly different application of it, and I'm going to show you that now. And then everything is taxed as it is now. Okay, which means that your savings pot, depending on your tax-free amount, could be paid out all as a tax-free or not, depending on how much you've got left. Okay, so let's have a look at this vested pot, which is slightly more complex. So in your vested pot, you've got your non-vested benefit layer and your vested benefit layer from an annuitization point of view, right? And anything that's pink there is paid out in cash, and the orange bit is the annuity. So your vested annuitization vested amount comes out as cash, and then your non-vested annuity amount comes out 2/3 as an annuity, 1/3 in cash. Now, when you're looking to see how de minimis applies on retirement, this is how you do it. Okay, and it's easier to do it in a picture if you're a picture person like me. So you add what you've got in your retirement pot to 2/3 of your non-vested amount in your vested pot. See the picture there where that arrow is? You add those two amounts together. If that amount is less than 165,000, you can pay everything in cash, right? So that is how the de minimis applies. Okay, so members won't see all of this. They will just get told at retirement, this is how much you have to annuitize, this is how much you're allowed to take in cash. They're not going to see, what's coming from which pots, etc., unless they ask for that. Okay, so on retirement, this is how it's going to work. Death benefits are much easier. So your pots basically all fall into a big pot or basin on death benefit on death. So that's the way I like to picture it in my mind. They're all smushed together. It's a very technical legal term. And basically the intention is we want it to work as it does now, right? So the latest wording in the RLAB is that all three pots can be paid out as an annuity or a lump sum depending on the beneficiary's choice. So in your rules, they will arise as an annuity, but they can be commuted from a lump sum for a lump sum, which is what 99.9% of beneficiaries do, and it's the beneficiary's choice to do that. And then, of course, this is all taxed as now in terms of your retirement lump sum tax table. So that doesn't change at all. I want to deal now with a very specific category of older member. Okay. And this category of older member, I'm going to go through exactly who falls into this category, but they can choose to be in the two-pot system or out of it. So just as a reminder of who's in this category, it is, and it'll come up on screen in the next slide, but just to remind you, it's a member of a provident fund who was 55 or older on the 1st of March 2021 and is still a member of the same provident fund. Right? So if you fall into that category of member, then you can choose to be in the two-pot system or out of it. By default, you are out of the two-pot system. If you decide you want to be in the two-pot system, this is an irrevocable once-off choice. You can't change your mind. Okay, so you decide I'm in, you're in forever until you retire. Now, this is what the RLAB 2024 says, right? This is what that new piece of legislation that has not even been introduced into Parliament yet says. It says that these older members can choose within 1 year of the 1st of September 2024 whether they want to opt into the two-pot system. So it's giving them a period within which they must opt in. Okay, in that period, you have to have opted in before, not on, before 1 September 2025. Okay, so that is new. And then what the same RLAB 2024 does is it says that they will get the same starting balance in their savings pot, but that is calculated on the last day of the month that they opt in. So say they opt in on the 15th of March, 2024, their seeding is calculated on the last day of March, therefore the 31st of March, 2024. Okay, so that is how it's said to be working now. All right, then they've got the same amount, the 10% capped at 30,000, right? That doesn't change. Okay, so there's a category. You can see it in the bright orange square up there. So if older members are out of the two-pot system, everything just keeps going as it is now, right? Nothing changes for them, right? So they will contribute to the vested pot. They're the only ones who can. And their whole retirement benefit can still be taken in cash when they retire, but they won't get a savings pot because everything carries on as normal. So they don't get a savings pot, and therefore they can't take money out of the fund while they are still employed. If you are in the two-pot system, so you say as an older member, I want to join the two-pot system. After election date, they then will have two pots, savings and retirement, and they'll get that starting balance in the savings pot when they opt in. And then their contributions after the date that they opt in will go to those two pots and not to the vested pot. So that means that if they opt in, they can then get money out of the fund while they are still employed and before retirement, because they'll get a savings pot. But what they lose out on is any of their contributions after the date that they opt in, plus fund return on that, will have to be annuitized when they get to retirement. So it means that for your older members, they will no longer, who are opted in, they will no longer be able to take that full amount in their whole retirement benefit in cash. There'll be an annuity portion. Now that, of course, is still subject to de minimis. Okay. So often for our older members, the choice comes down to many things, but one of those things is what is more important to you. Do you want cash now, in which case opt in, or you want more cash on retirement? Don't opt in. Okay, so of course, getting counseling and advice on this is very important for our older members. Okay, so that's all I've got for you today from a structured point of view, but I'd really like to take some questions. So I'm hoping that there are lots of questions, and you're very welcome to add questions as I'm answering them. So the first question is, if you transfer your vested pot to your retirement pot, it can't be reversed. Yes, exactly. So if you transfer your savings or your vested pot to your retirement pot, you can never reverse that. It's a one-way traffic, one-way road. Okay. The next question is, can the underlying investments differ between the savings and retirement component? Okay, that's an interesting question, and it is something that I'm sure your investment consultants will be speaking to you about, but the answer is yes, that is possible. So you can have different investments sitting behind different pots or components. Whether or not that's a good idea is a different story. Okay, so at a recent conference that I attended, we put up a question on this to say how many people in the audience, about 500 people there, are thinking about having different investments behind different pots. And it was a small percentage that were, and the larger percentage, I think, just want to get through two pots, and then they can start thinking about that. And I think that this question is perhaps only going to be more relevant once we have more assets sitting in savings pots and retirement pots. Okay, will the recording slideshow be available to us? I think yes, the answer to that is yes. Why would an older member of a provident fund want to opt in? Okay, so one of the reasons why they might want to opt in is to get access to a savings pot. right? Because the moment they opt in, their contributions are split between a retirement pot and a savings pot. And they get that starting balance in their savings pot as well, which means that if they opt in, they can take some of their retirement savings out of the fund without leaving employment. If they don't opt in, they can't take money out of the fund while they're still in employment. So that would be one reason. Okay, then, the next question is not for me. It is in relation to the Signature and Skelton portfolios. And then there's another question. I assume that deferred retirees, members 55 years and older have not opted in, will not have seeding. You may have covered that up front, Leanne. So, okay, let me think this through. So you've got a deferred retiree who is also in that special category of members. Okay, so if your deferred retiree is in that special category of older member, then they will be automatically out, and they will have to opt in if they want to opt in. So if you have a deferred retiree, so that is someone who's retired from their employer, reached retirement age on the fund, but not yet taken their retirement benefits. So that's what a deferred retiree is. So they're not yet a pensioner, therefore that exemption doesn't apply to them. So strictly speaking, yes, they can get access to their savings pot. Now, of course, that is a bit of a loophole, isn't it? Because if you retire and you don't work for a year, and then you take your savings pots, and if marginal rate is applied to your savings pot, your marginal rate is going to be extremely low, if anything. Okay, which means you can maximize the tax that you pay on your savings pot by deciding how much to take as a savings withdrawal benefit and how much to take on retirement where your tax-free amount applies. So Treasury is aware of this loophole, for want of a better word, and they need to clarify if a deferred retiree takes their savings pot after they reach the age they can retire, so they're a deferred retiree, will it be taxed at marginal rates or not? Okay, and that's something that they're going to have to clarify. So it's a good question, and it is a bit of a loophole. Just want to check if there are any more questions. Okay, here it goes. The savings pot. Should this not be in money market portfolio, or would this be a member's choice as well? So I've talked about the fact that for most funds, and not all, but for most or many funds, they will not have a separate investment portfolio or choices sitting behind different pots. And that's because for most funds, they've got enough liquidity anyway in order to be able to pay out savings withdrawal benefits and savings pots. But again, this is fund dependent, and I'm not going to answer it for your fund. Any more questions? Okay, here's another one. If the legislation was designed to protect members 55 years and older at 1 March 2021 from being forced to annuitize, then why is this protection not in place when these members change funds, often not of their own choosing? Good question. Okay, and remember that annuitization did exactly the same thing. So for these 55 and old on 1 March 2021, the requirement on annuitization was that you must always be a member of the same fund in order for that to apply. So if they transferred between funds, they lost that. Okay, and the same thing is applying here. Now, what I can tell you, and it might be helpful, and although it's confusing, is that this is still a discussion going on between Treasury and the industry. But at this stage, if you are an older member in that category and you move funds, that will mean that you are automatically defaulted into 2 pots. Okay. And we know, I get that it's not fair. I understand that, understand the protection of vested benefits, but this has always been an issue ever since, March 2021 when annuitization came in. Okay, I think that is all the questions that I can see on 2 pots. I hope I've answered them all. Yeah, so thank you so much for all your questions. I really appreciate it. It always makes it more exciting and fun for everybody. So thank you for those.
Thank you very much, Leanne. Yeah, so that brings us to the end of today's webinar. And as Marius mentioned right at the beginning, And we will be continuing this, and so look out for communication to the next SURF webinar and the next exciting topics. If there are any other questions that still streams through, we will collate them and then of course have the relevant panelists answer them. But of course, you can always reach out to us as the Sygnia team. So thank you very much for joining today, and we trust you have a good day further. Goodbye.